Welcome back to the Keiser Report. I'm Max Keiser. Speaking of Wall Street nudniks, I'm here with Mitch Feirstein, author of Planet Ponzi. Mitch, well, how do you, I mean, you're still working on the City of London? You're still money manager after all this?
Of course. This is not a green screen. Real background. Thanks for having me back.
Oh, my God. All right, Mitch Feirstein. Listen, you got to tell us about your trip to Italy. So you found anecdotally that the economy, because of course you're sailing around the Mediterranean with all your swish posh buddies there, tell us what you found out.
I'll tell you that you can see that the economy is not doing as well as it's portrayed by the ECB and Mario Draghi, ex-Goldman Mario Draghi. A lot of the restaurants and the bars that we frequented to have a couple cocktails were very empty, and the people that own them were complaining.
Maybe they just don't like
you. They were
you.
complaining.
Maybe they're like, there's Mitch Feirstein, the guy from the KeiseReport. Let's run. They're out the back door. Then you are coming in the front door, and they're like, oh, God, thank God. That guy is a serious buzz killer.
It could be, but when you're in the city center and you walk through these little piazzas where you're seeing like everybody sitting outside and having a beer, when it's 60% empty in the middle to end of July, that should tell you something.
Okay, let me stop you right there. Because if that's true, why are the Italian bond market and the Spanish bond market and all these bond markets in Europe hitting new all-time highs?
People are closing their eyes and buying the highs. I mean, it's madness because they're chasing yield. And it's like an injecting heroin into their veins, because these bonds and the debt from Italy, Spain, Portugal can never be repaid. It's a pipe dream. So eventually they're going to default, but they've been kicking the can down the road, and they've done a pretty good job at kicking the can down the road. Now they're doing the asset quality review, which is probably the most opaque test in the world. We're not going to tell you how we're going to test the assets.
What's the asset quality review? This is a new stress test.
Yeah, this is basically a stress test that the ECB is going to do.
The European Central Bank.
Right. The European Central Bank is doing a stress test on their banks to say everything's fine, everything's cool, just like when they did the stress test on Dexia a while back, and 2 weeks later they went bankrupt. So all of these assets, because of the money printing, are overpriced in terms of price, so yield is at a historic low when there's no possibility that they can pay these bonds
But
back.
These stress tests are bogus. They just do this for cosmetic reasons, or as you would say, lipstick on a pig.
Yeah, that's exactly right. It's tons of lipstick on a pig to make people feel comfortable to buy them so the governments don't have them on their books. But then when the stuff fails, like Argentina, you're not seeing mainstream media tell you that Argentina is about to default in 3 days once again on 1.5 billion of their bonds, which is going to cause a cascade in other parts of the banking system.
Well, is it going to? Well, let me ask you first. What do you think about this Argentinian situation? Because you have I think it's Paul Singer. He's a vulture capitalist. He buys the debt on the cheap during the stressful times, and then he sues the bank for 100% on the dollar. A lot of people, like our friend Greg Palast, who's an investigative journalist, goes down there and he finds Paul Singer and he challenges him. You're a vulture capitalist. You're no good. Okay, you're in the banking industry, Mitch. You're on the other side of this debate, possibly. I don't know. How do you weigh in on this?
The problem is there are no rules anymore, because the Fed, the ECB, the Bank of England, they've changed the game. They've moved the goalposts after the game and said, no, we're calling these plays back. So there's a total misallocation of capital. People are throwing money to chase yield, and people are not assessing risk properly. All the old risk managers, such as myself, are gone.
If interest rates are zero, is it harder or easier to assess risk?
It should always be the same to assess risk, but people are putting money into stuff that should be trading at 20%, but because interest rates have been manipulated to zero, it's trading below 5%. If you remove the dividend discount model, the dividend discount model, if you remove that, interest rates are zero, the yardstick for measuring risk is gone.
That's correct. There's no yardstick for measuring risk. As you say, there are no rules. The answer is it's harder. You've given the wrong answer, you get a demerit.
Oh, no.
Negative. You gave the wrong answer. But speaking of charts, Mitch Feirstein.
We have some charts.
Mitch has some charts. That's the thing. That's going to say in your epitaph. You're going to be 6 feet under.
He had charts.
He had charts. All right, now let's compare today's market with the Great Depression.
Okay, so we've got the first chart that we're going to see is the Dow Jones Industrial Average from 1926 to 1929. You remember what happened, Party Like It's 1929, that song? Anyway, the Dow went up 181%. And then from 1929 to 1932, our second chart, you'll see what goes up must come down. And what we can see from this one is it's up the staircase and right down the elevator shaft, down 89%. Now, recently in 1998, what we're replicating today, 1998 to 2000, we had the NASDAQ.com bomb. and we'll have a chart of that, we can see that the NASDAQ went up a rocketing 255% in 2 years. And then on the downside, from 2000 to 2002, it dropped 78% and destroyed $5 trillion in market cap because of Greenspan's irrational exuberance, where 52% of these companies, no-income companies, disappeared and went bust in the dot-com bomb. Now, the next chart we have is the Dow currently from 2009 to 2014, which has gone up 162%. So now we have to ask ourselves, is this the new neutral, or is this a setup for a catastrophic financial disaster and collapse that we've seen in history before? The last chart now is a company called CYNK. This is a fraudulent company. I don't know if you know anything about it. That because there's no more price discovery and hyperinflation in asset classes, the markets now trade in a momentum-based frenzy, drove the price of this stock up to around, as we can see on the chart, around $21 a share. And then the regulators came in and said, oh my God, this company has no employees, no income, no revenue, no nothing. So they came in and stopped trading for 10 days. The interesting thing is, being a fraudulent company in a rigged market, that when trading started again, it started trading at around $5 and people were still trading the stock when it didn't exist and it's clearly fraud.
Right. This is like in the old days when I was working on Wall Street, we had what were known as the pink sheets. Okay, these are bulletin board traded stocks that were trading for a penny, 2 pennies, 5 pennies. And this is the kind of boiler room action you would see happen on these thinly traded, no name, no product companies, and it was a bit of a farce. It's amazing that now you're seeing the same tactic being used in multi-billion-dollar companies. They've turned the entire global stock market into a boiler room, pink sheet, speculative kind of shenanigans that has no basis in reality whatsoever.
Well, a billion is the new million, just like green is the new black. So, I mean, it doesn't really matter anymore. People don't look at valuation and they don't look at value. We have to get back to the metric. I mean, nobody's talking about...
But without an interest rate to...
a risk-free rate. So
yeah.
If you look at what's going on and everybody says the economy is great, everything's doing well, GDP is rolling right along, but if you look, the 10-year treasury yield is below 2.5%, which tells you that the economy is not in a good state. I mean, you can fake it till you make it with the numbers, which is what they've been doing.
Yeah. Well, I mean, let's just, move on here. So, Osborne talks about a recovery in the UK, but it seems to me that it's really a misuse of the language, because after the crisis of 2008, they just doubled the debt. So they let the credit cards spin out of control by 600 billion pounds. But is that a recovery, Mitch?
Well, no, I don't think we're seeing a recovery. But when they tell you things, I mean, it's like they're changing the calculation and basis for GDP calculations starting in September. So, for example, Greece, when you look at them, they had a 4% recession, which is going to shrink down to 0.3%, a change of 3.7%. And this year, 2014's GDP will go from 0.6% plus to a robust 3.6. They're adding things because they're changing. It's a once, as ONS calls it, the Office of National Statistics in the UK, it's a once-in-a-generation revision, lifetime revision of the way they calculate these numbers. Now, going back to George Osborne's great recovery that he's heralding, if you look at construction, service is the biggest part of the GDP component, service sector. Construction was down, finance was down, so all the high-paying, good-quality jobs in the economy didn't have an uptick. So we are not back where we were. If you look, the debt has gone up. The spending, government spending has gone up grossly, and tax revenues have declined at the same time. While real revenues, in terms of what people are earning, wages, have come down between 10 and 14% in the past 4 to 5 years.
Okay, well, isn't it true that you can prove that George Osborne is lying in one simple statement? And that is the fact that if there is a recovery, Georgie Porgy, why are you not raising interest rates? Okay, interest rates would be rising along with the recovery. That's what interest rates are there for. That's what the Bank of England is there to do. That's what Mark Carney's job is. So
I agree 100%.
So that is a litmus test to say this man, George Osborne, the Chancellor of the Exchequer, is a liar. It's not a recovery. It's a bubble in asset prices. No matter how you look.
It's hyperinflation in asset classes. But you know what is going on here?
Yeah, I do what's going on. It's a farce. It's a tragedy.
No, you can't taper a Ponzi scheme. That's what they're saying in headlines, in neon lights. It's bright, right?
Well, what does that mean? In other words, what Osborne has been able to do is you've got an economy that's wed to asset price bubbles for the equity extraction to go out and shop based on the money you're borrowing against your inflated house price. That's the so-called recovery. It's not jobs. It's not recovery. It's not manufacturing. It's not labor. It's not wages. It's just people taking money out of inflated assets to go shopping. When those inflated assets revert to the mean, just like night follows day, and everyone's getting underwater in their house again, and shopping comes to a complete halt. You know, George Osborne will be on the lecture circuit with Janet Yellen for $200,000,
for lunch
dollars a pop.
Talking
about how they saved the British economy, when in fact he jammed it up the Schmovery by lying through his teeth day in and day out.
But if you look at the budget deficit and the public sector borrowing for June, just take that number year on year. Okay, that's up about 40%. So it was 11.4 billion, which is about 4
All right, you know what?
billion higher.
That's boring. I'm going to move on to my next point. Listen to this.
Okay.
Mitch Feirstein, your charts, they're all, forget them. They stink. Get them out of here. I'm taking them off. We're moving on. We got a minute left. This is the proof of Osborne's lie. Okay.
But he's running for prime minister. So
Can I ask the question?
Okay.
Okay, income tax on revenue to the Treasury went up 3%. Stamp duty is up 40%. Again, that points out in no uncertain terms, in black and white, the lie. It's all based on real estate speculation, not on a real recovering economy.
Well, yeah, there's rampant real estate speculation. This is going to blow up like in an epic fashion. I mean,
but those are the assets we're talking about that are being blown up by this ridiculous central bank policy.
What this is hyperinflation in selective asset classes. It's hyperinflation. It's not just inflation. And the Mark Carney and George Osborne are doing nothing to control the property bubble, and people are going to get hurt in a bad way. Because people who are buying in London at these prices, when they collapse, it's going to be catastrophic. Just like what happened in Japan. From 1987 to current day, it's dropped about 90% from peak to trough. And it's never come back. It will never come back in our lifetime. People are saying the property markets are cyclical in the UK. Oh, it might come down 10%, but it's going to go right back up to new highs. It's not going to ever go back up to new highs. This is a tulip bulb mania that will never be repeated, and it will go down in history, and those guys will go in the history books as the ones that pushed it over the edge. It's going to be Humpty Dumpty, and all the king's horses and all the king's men will not be able to put the property market back together again.
Well said, Mitch Feirstein. We got to go, but thanks again for being on the Keiser Report.
Thanks for having me.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Mitch Feirstein, author of PlanetPonzi.com. If you'd like to get in touch, tweet us at Keiser Report. Until next time, bye, y'all.